into the weeds, but the dirty little secret of life and tax is it's all basics. So you just keep it simple. And here we go. My little table of contents, we're going to talk about what the problem is, and you can identify precisely what question you are answering. And then we're going to go down the list of the various taxes that you need to think about: estate tax, capital gain tax, rental income. Embedded in rental income is going to be personal holding company income and accumulated earnings tax. Embedded in capital gains and rental income, we're going to talk about branch profits tax at the same time. Item 5, I'm going to do a little drive-by, hand-wavy acknowledgement of some other things going on. And then we're going to wrap it up, and we will wrap it up within the hour because there are no souls saved after 60 minutes. So let's start by identifying the problem, what solutions you should be looking for, and what the criteria are that you will use, at least for tax purposes, when you're choosing a solution. Handy little picture of a grant deed. So somebody's in the midst of buying U.S. real property. This somebody is a non-resident of the United States. Sooner or later in the purchase process, somebody, usually the escrow agent or title officer, is going to say, how do you want to take title? And what is put right there is what's going to dictate the tax consequences for the buyer from now until the buyer disposes of the property, either by selling it or by dying. So this is precisely the question that you're going to be answering when they come in and incoherently and hand wavy, they say, what do I do? This is my sort of super simple little diagram of all of the different families of choices that you have for holding structures. So starting on the left, direct ownership. You insert your name here on the grant deed. There are then going to be disregarded entity choices, either a domestic disregarded entity or a foreign disregarded entity. The blue ones are the whole family of corporate structures. Domestic corporation directly owns the real estate, foreign corporation directly owns the real estate, or you have a parent substructure. Then we have trusts. We have irrevocable trusts and we have revocable trusts. And finally, we have partnership structures. Now, a heads up, I'm going to be pretending that your client, the buyer, is a single humanoid and not a group of humans. And therefore, I'm going to ignore the partnership stuff. But I wanted to put it there just to let you know they exist. And there will be a few acknowledgments of what's going on with those partnerships, but not much, because partnership stuff is weird enough for foreigners that it deserves its own time frame. And in fact, last year I did a whole hour on just partnership structures for real estate investment. So that's kind of what we'll be looking at today. So I'm going to ignore the direct ownership one, and because we're only going to be looking at structures, meaning entities that you can put between the buyer, the human, the non-resident, and the real estate to achieve some kind of tax benefit. Now, I said you need to think about criteria. There are a lot of non-tax ideas and criteria that you'll consider, but these are the tax questions that you'll be asking yourself and answering for the client when you're trying to advise them on what kind of holding structure to have. Estate tax is the big one. And all of the people that come to me for advice, they all know about the estate tax, and it's, you know, they have no plan to die. On the other hand, people die, and it's a big tax. Then we have income taxes. We have income tax on the capital gain when the property is sold, or we have income tax on rental income if this is a rental property. And just for purposes of this presentation today, I'm going to be talking about investment property that'll generate rental income. I'm not talking about the vacation home kind of concept, just because, yeah, I've only got an hour. All right. Finally, for corporate structures only, if you have a direct ownership of U.S. real estate by a foreign corporation, then you've got the branch profits tax to consider. If you have domestic corporation as the title holder on the U.S. real estate, you've got these little things, the accumulated earnings tax and the personal holding company tax, that are there to encourage the corporation to declare a dividend and pay it out to the shareholder. And you probably do not want to declare a dividend because the dividend will be taxable to the shareholder. And you don't want to pay these taxes as well. So you're going to have to figure out a solution for that if you're using a domestic corporation as the title holder. Right. Let's launch into the big one. 40% under current law of the value of the U.S. assets are going to be taxable if your client falls over dead. That's going to be the big concern. These are the ones with the little yellow goldy kind of stars are the structures that will act as firewalls so that your client can die cheerfully and be comfortable that there will be no estate tax imposed that the heirs have to take care of. Foreign corporation is a direct owner, a foreign parent, domestic sub kind of structure, and an irrevocable trust. Those are the solutions that work. There, you see on the far right, I have a question mark in a red star for a partnership structure. This is something that's been debated by law professors for decades about whether there is estate tax in this situation. The idea is that if you've got a dead non-resident alien decedent who owns a foreign partnership interest, that foreign partnership interest is a foreign situs asset. Therefore, it is not included in the decedent's gross estate for U.S. estate tax purposes. Therefore, it acts as a firewall. We believe this to be true, but there is no certainty. And I can tell you, for having done this for almost 40 years, people don't want to be the test drive crash test dummy in tax court to prove or disprove something that's been debated for decades by law professors. So I personally have never set one of these things up. I've got a buddy here in Pasadena, Rufus Rhodes, who wrote a big ass book about international tax. He's never set one up like this. There may be people who are bolder than both of us, but anyway, that's my opinion. Right. So why, this is the big picture. Why can we be sure that there's going to be no estate tax? Well, because we're going to zero out the gross estate. Remember that estate tax is only imposed when you have a dead person who has a gross estate, as defined in Section 2033, 2031, I forget which. And so we are going to use these structures in such a way that we can prove to the IRS that the decedent did not have a gross estate as defined for U.S. estate tax purposes. So here's a simple example of direct ownership and why it's a bad thing to have direct ownership and the impact of having U.S. assets in your gross estate if you're a non-resident. And the easiest way to do this is just to look at the 706NA, and let's look at the definition of the taxable estate. Under my simple example where you had the dead person owned a $4 million piece of real estate in the United States and a $6 million piece of real estate outside the US, that's everything that person owned. This is what the taxable estate calculation would look like. Gross estate in the United States, $4 million. Line 2 is gross estate outside the US. And here's an interesting little thing. It said our Internal Revenue Code says if you forego the ability to deduct administration expenses, blah, 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 see lines 4 and 5 and 6, well, 4 and 5, then you do not include your foreign assets as part of the gross estate. But if you want those deductions, you have to declare all of your assets worldwide, and then you get a pro rata deduction for the various expenses. So invariably, it's better off, well, not invariably, but 95% of the time, it's better off that you just declare the US assets and leave the foreign assets off the picture and off this Form 706NA. So you can see here that we have a taxable estate of $4 million, and we'll do the math, and then you're going to have a big ass estate tax. So that's bad. So this shows you the effect of direct ownership of a US asset when you have a non-resident who falls over dead. Now, the two ways we can prevent this with structures. First, the irrevocable trust. Why does this work to prevent estate tax? Here's my little handy dandy picture with the whistling beneficiary and the settlor. Settlor is the person who creates the trust and gives assets to the trust, and then the trust goes and buys US real estate. Beneficiary is whoever the beneficiary is, who will receive distributions from the trust even when the trustee decides to make distributions. Why does this work? It works because you drafted the trust document correctly so that the settlor does not have any retained interests in the trust assets. So this is Internal Revenue Code section 2036 through 2038. So if you do your job correctly, then the settlor is not treated as if he or she has indirect ownership of the US real estate inside the trust. Basically, think of retained interests as a gift with strings attached. And if the strings are robust enough, then the government just says, the assets are really yours. And that's what a retained interest is. Similarly, if the beneficiary falls over dead, we can be comfortable that there will be no estate tax imposed on the value of the US real estate in this trust. Why is that? Because we were careful when we drafted the trust to not give the beneficiary a general power of appointment over the trust assets. General power of appointment basically is a power that the beneficiary can tell the trustee, give me the assets anytime I want them. And that's section 2041 of the Internal Revenue Code. So you draft the trust document correctly. Also, you don't override a correctly drafted trust document by doing BS in practice. So if in practice the beneficiary is controlling things, or if in practice the settlor is controlling things, then you might have a problem if you're audited. But that's the concept. And here is the little explanation and citation to the code and all that fun stuff. Note the important things down at the bottom. These principles apply whether you use a domestic trust or a foreign trust. I think that if you have, I used to go 100% foreign trusts, and now I'm more and more biased towards domestic trusts, just because the paperwork and the tax compliance is a little bit simpler to me. A 1041 for the domestic trust rather than a 1040 NR for the foreign trust. And the other thing I like about the domestic trust is when it comes time to selling the property, you say, well, okay, we've got to worry about this FERPTA withholding, 15% of the gross sale price. Well, now we have a domestic seller, and therefore the 15% of FERPTA withholding, on sale does not apply because the withholding only applies to foreign sellers. The withholding obligation is then passed over to the trustee of the domestic non-grantor trust, but that's just the usual thing when you have taxable income inside a trust and it's allocated to non-resident alien beneficiaries. You got the whole game there to go, but that's no big deal. So anyway, so there's your overview for why an irrevocable trust is a good thing. And just to go back to the Form 706NA Schedule B, here you see why we've got a 0 for the taxable estate. It's because the settlor who fell over dead in my example has a gross estate in the United States of 0 because the settlor did not have a retained interest in the trust assets as defined under sections 2036 through 2038. So it works. Now, let's go move on to the second one, why a foreign corporation prevents estate tax. So the foreign corporation is going to be a firewall against the estate tax being imposed on the estate of a non-resident alien decedent for a very simple reason. You ask yourself, when the little stick figure at the top dies, What did the little stick figure own as a decedent? Well, the answer is this little stick figure owned shares of a foreign corporation. The estate tax rules for non-resident alien decedents will say, okay, where is that asset that the dead person owned? Is it foreign or is it domestic? If it's foreign and you have a foreign dead person, then that asset is out of bounds for U.S. estate tax. And shares of a foreign corporation are foreign situs assets. And I give you the citation there. Therefore, the U.S. real estate is not subject to estate tax because the estate tax rules respect the corporate character of that foreign corporation that holds title, and there's no estate tax. So again, yay. Now, you can do all sorts of things. And in fact, I kind of recommend that you do think about doing all sorts of things as subsidiaries underneath the foreign corporation. It makes no difference for the estate tax, but it'll quite often give you some kind of income tax benefit. For instance, dealing with rental income, or for instance, dealing with the FERPTA withholding when there's a sale, or for instance, there's some non-tax aspects of it, like if you want to go open a bank account so you can pay the bills for managing this real estate, walking into Wells Fargo with a domestic corporation, it's a lot easier to open up a bank account than walking in with a Bahamas corporation. They're just going to look at you funny if you have a foreign corporation. So absolutely think of stuff like this, festoon the whole structure with entities underneath. And I like LLCs there. Keeps it simple. It's easy to open bank accounts. It really doesn't interfere with the tax attributes that you're planning. And again, why does it work? Okay, it's the gross estate in the United States is zero because all of the assets that this dead person owned are foreign situs. So you can see on line 2, I've just made a notation that the foreign corporation stock goes on line 2, and we're excluding that because we're not trying to claim any administrative expenses or anything like that to reduce the taxable estate. To reduce the gross estate to the taxable estate. So that's why it's going to work. Not that you would file a 706NA in this situation anyway, but that's what it would look like if you did. All right. So you've got something that works. Now let's talk about what doesn't work. All the little black stars. Direct ownership, you saw that before. Domestic disregarded entity. Technically, the asset is a membership interest in a disregarded entity, which is going to be a U.S. situs asset, and the value of that U.S. situs asset is going to be the value of its assets inside the disregarded entity. The foreign disregarded entity, I don't know. There's a case, and I've just given you the name, Suzanne Pierre versus Commissioner, where it was a New York LLC, and it was a disregarded entity. And you know how in the tax law, it says if you make this election, then the entity is disregarded for all tax purposes. And tax court said, hey, wait a minute. When you say it's disregarded for all tax purposes, in fact, it's not. It's disregarded for income tax, but not for estate and gift tax purposes. Well, Suzanne Pierre was a gift tax, but the same logic applies to estate tax. And so in theory, you see the little check, the red star over to the far right, and I told you about partnerships. In theory, maybe possibly, you could take the position that a non-resident decedent owning the interests in a foreign disregarded entity owned a foreign situs asset, therefore there's no estate tax. Not that I'd be willing to throw myself under that bus, but it's a theory. And, maybe if you had somebody who died first and then asked you for advice, you might try to push that to see if you can win in tax court, because why not? Domestic corporation, the person falls over dead. What do they own? Shares of a domestic corporation. The asset is located where the corporation was formed. Therefore, it's a domestic asset, therefore estate tax. Revocable trust, that's an example of a retained interest. I forget which number in 2036 through 2038 it is, but one of those says that if the settlor has the power to revoke, then that constitutes a retained interest, and therefore you have an inclusion in the gross estate. Domestic partnership, a domestic partnership interest is located where the partnership is formed. Therefore, you're a dead duck. You've got a domestic asset. So there you go. These do not work. And the only solution in that situation I know of is life insurance. So here's my little conclusion. I will heavily recommend lower tier entities below whatever kind of estate tax firewall you use, whether it's a trust or a foreign corporation, simply for management purposes. Right. Moving on. Capital gains tax. This is kind of up in the air because you know what Uncle Joe and Congress is doing right now, which is who knows. But all we can know for sure is that something's going to change. So let's look at what current reality looks like, and then we'll just hold our fire until Congress does something, and then we can figure out what the effective income tax, the capital gain tax rates are going to be on a typical structure. So I've given you three examples here. What if a domestic corporation is the direct owner? What if a foreign corporation is the direct owner? And what if it's a irrevocable trust and a foreign trust beneficiary? So you're going to issue a K-1 from the trust and everything is going to go straight up to the beneficiary who files Form 1040-NR and reports whatever gain is allocated to the beneficiary. So look at the tax rates. So current federal corporate tax rate is 21%. Who knows what will happen there? Same rate applies to domestic and foreign corporations. And the long-term capital gain rate currently is 20% for humans. Note a really cool thing if you are a non-resident investor in U.S. real estate that you pay 20% long-term capital gain tax rate. You do not pay the 3.8% Obamacare tax because non-resident aliens are exempt from the net income tax, investment income tax. So if, me as a U.S. citizen, I pay 23.8% to the federal government. My evil twin separated at birth, who is a non-resident alien, is only going to pay 20% on the same investment. So you're slightly better off net being a non-resident alien investor in U.S. real estate, which gives a slight economic advantage to foreign investors over domestic investors. So there you go. California tax rate. So look at the California tax rate for corporations. And again, 8.84, that's it. But look at the stretch between 0 and 13.3% for individuals. A massive difference. So the rate differential between corporations and individual structures, and I include trusts as part of that because they're just pass through, can be quite profound, especially as the capital gain amount goes up. Here's where let's talk about the state income tax. So first things first, can we get a deduction? The answer is yes, Internal Revenue Code Section 164. What's really important is the limit in the amount of the deduction that's allowable. Corporations have infinite deductibility, no limit. Humans have this $10,000 limit that we currently enjoy. And therefore, advantage seemingly to corporations. So let's look at the effect of the tax rate on, I'm just picking a random example of $2 million capital gain on sale of real estate. And we've got side by side, a foreign corporation owns the property directly or a trust, and we're allocating all of the gain to the trust beneficiary. We can see the California tax for corporation is considerably less than the tax imposed on the human. And if you want, I don't know if we uploaded it to the CalCPA site, but if you want, we have some dummy tax returns that demonstrate all of these things. So you can take a look and see how the numbers flow through an 1120F and 100 for the corporation and the 1040NR and 540NR for the trust beneficiary. So just ping me, ask for it, we'll send you the PDFs. So now let's look at this tax deduction. So we saw that the tax rate differential favors the corporation. Let's look side by side after we look at the tax deduction differential, what happens. So look at the second row, the deduction for state income tax paid. You know, significant advantage for the foreign corporation. So the taxable income is much less. Tax rate, 21% for federal purposes. Worksheet, just because that's the way it works for humans. And you can see what the federal income tax liability differential is. It ain't that much. Well, then we've got AMT that we have to add back for the trust beneficiary because government hates humans and loves corporations, I guess. And there you have the total federal tax liability, 382, 872 for a foreign corporation and 371 for the trust beneficiary. It's not a big deal under current tax rules. Again, wait for Congress to act and see what they do. But at the moment, the spread is frankly not worth worrying about. So let's just add everything together, state and federal income tax liabilities, and look at what the total tax load is. Round numbers 560 for a foreign corporation and round numbers 610 for the trust structure. So $50,000 of total tax liability differential on 2 million capital gain. That's a 2.5 spread. And yeah, 50,000 is 50,000. But in the big scheme of things, especially when you have smaller real estate where you're likely to have much less capital gain, I don't think it makes a big difference. And so in terms of capital gain, at least, I treat these two things as a push, again, until Congress does otherwise. Now let's look at the branch profits tax problem, because you definitely need to worry about that if you're going to use the foreign corporation structure. Here's the easiest way to understand what the branch profits tax is by looking at the 1120F, so Section 3, Part 1. And this is the little work area where you figure out what your branch profits tax is. So I'm just going to walk it through, and this is like your 2-minute introduction to branch profits tax. So you start with taxable income pulled over from the previous section, because remember, taxable income is where you start for E&P purposes. And then line 2 and 3, you're doing some E&P adjustments, which frankly are not going to matter to you at all when you have a foreign corporation that the only thing it does is own a single piece of real estate. Because you see in line 2, it says effectively connected earnings and profits. That means earnings and profits generated from U.S. business activities. And if you only have one asset in here and it's a U.S. rental property, then 100% of the earnings and profits are always going to be effectively connected. So likely that line 2 and 3 are going to be zeros. Well, line 2 is going to be a 0, and line 3 is going to be the net effect of lines 1 and 2. But what happens that's interesting are in line 4A through 4E. This is adjustments. Now, here's the big picture philosophy for branch profits tax. They're trying to calculate a proxy for what cash is available for dividends payable by this foreign corporation actively engaged in business in the United States to its foreign shareholders. Because think of it this way. If somehow cash goes upstream to the foreign corporation and it's now outside the United States and the foreign corporation pays a dividend to the foreign shareholder, that dividend payment is out of bounds for the U.S. tax system. Whereas compared to that same shareholder has a domestic corporation doing the identical business in the United States. Now that domestic corporation pays a dividend to the foreign shareholder, 30% default withholding on the dividend payable less by treaty. So the idea is that they want to make sure that you can't skip out on that dividend, and they're trying to make it a matter of indifference to you for tax purposes, whether you use a foreign corporation operating in the United States directly as a branch, that's the jargon, or you use a U.S. corporation, a subsidiary. In either event, they want corporate income tax on profits to be the same. And in both scenarios, the tax imposed on the shareholder for distributions from that corporation to be the same. So the whole purpose of 4A through E is to get you to that line 5, which is the dividend equivalent amount. And if you think about, okay, you're looking at a corporation, you say, how much cash is available for a dividend? Well, it's going to be a function of two things: what you had income for the year, and then what you did with that income. Did you reinvest it in assets? In that case, you have less cash and you can make a smaller dividend, or none if you reinvested all the cash. If you liquidated some assets, now you have more cash available and potentially a bigger dividend. And so line 4 is this thing, US net equity. Did you take your taxable income? Did you invest it in US assets, or did you somehow reduce your US net assets? And so that's where all the fun and games happens for you. But at the end, line 5, you have a dividend equivalent amount, and then you have line 6, which is the tax, which is 30% of the dividend equivalent amount. So again, back to the tax on top of a tax idea. Line 1, you're going to pay corporate income tax on the taxable income. And line 6, if you have a dividend equivalent greater than 0 on line 5, you're going to pay 30% of whatever's on line 5. So you have an incentive to do something on lines 4A through 4E to make that dividend equivalent number on 5 to be 0. And there are 3 ways to do this. The first thing is you can reinvest all of the taxable income into US real property, not real property, any kind of US assets. And I'll give you the citation. The second way you can do it is there's a special rule that says when the foreign corporation stops doing business in the United States, then you can exit the United States with all of your E&P and all of your cash without worrying about the branch profits tax at all. And the third one is, well, let's not have direct business activities in the United States by a foreign corporation. Let's have a parent-sub relationship, and we'll have a domestic subsidiary, because branch profits tax only applies to foreign corporations. It does not apply to domestic corporations. And if the domestic corporation makes the income, there's no problem for branch profits tax. And so here's solution number 1, reinvest. What that means is you're going to increase your US net equity on line 4C, which is going to reduce, you're going to do it as a subtraction from taxable income and bring your dividend equivalent down, and therefore your branch profits tax on line 6 down. So simple example, you have $1,000 of taxable income, you use that $1,000 to pay down the mortgage. Bang, you've increased your net equity by $1,000, there's no branch profits tax. So there's an example. Solution number 2, and this happens a lot, and I would say as almost every time we have a sale by a foreign corporation, we're using this thing. Maybe it's belt and suspenders, but we're going to do this. So the branch, I give the citation to the temp regs there that says this is why it works. And you can see the little thumbnail sketch, the thumbnail picture of Form 8848, which is the paperwork requirement that you need in order to make this thing work. But the basic idea is in the year that you sell the foreign in the year that the foreign corporation sells the US real estate, you end up with no more US assets. You promise not to have any US business activities for the next 3 years, and you file Form 8848. And if so, then you don't have to worry about the branch profits tax. What that means is that the foreign corporation will pay corporate income tax on its capital gain, the end. That's the only tax imposed, the federal tax, I should say. Now, you can either be dumb or you can be stupid. So here's the dumb, well, did I just say that? Okay, you can either be dumb or you can be smart. How to make solution 2 impossible. So remember, this is the deal that in the year of sale of the US real estate, you completely take the foreign corporation out of the United States and you stay out for 3 years. What happens if you sell one of these 2 pieces of property? Well, you still have a US asset and it's a rental property, so you're still doing business in the United States. Therefore, you can't use that temp regs exemption that you wanted to use, and therefore you're going to pay capital gains will be taxed at 21% current rates, and then your taxable income after all of the adjustments that you're making will be taxed at 30% on top of that. So a combined effective rate of federal tax rate of round numbers 50%. Bad. So what do you do? Corporations are cheap. So just spin up a little corporation, one for each piece of property that you have. And if so, you sell one of these things, you liquidate it, and you take the money offshore and put it in the shareholder's pocket. The other corporation continues to move along, and you've got no problem with the branch profits tax for the corporation that sold its U.S. real estate. Solution number 3. This is the solution that takes advantage of the concept that branch profits tax only applies to a foreign corporation, and therefore we're going to have all of the income earned by a domestic corporation. Therefore, you will look in vain on Form 1120 for branch profits tax because there is none that applies. So in that case, the federal tax is going to be 21% on the gain, and you're done. Except now that you've done that, you have a C corporation that's a giant bucket of cash. And what do you do next? And let's talk about it. The problem is the client is unlikely to want to have a domestic C corporation with a bunch of cash inside it. And if the client wanted to do a 1031, they would have done it. So really, in a sale scenario, they're looking to take the cash home, put it in their pocket. So how do we do this without the classic 2 layers of tax problem? Pay tax at the corporate level on the gain and then pay tax again on the dividend when it's paid out. Here's your solution. So I'm going to walk you from left to right. You start with this 2-tier foreign parent domestic subsidiary structure. Step 2, you're going to sell the property, and at that moment you have pre-tax cash. So cash net of all of your expenses of sale, which is going to be, and so now you've got a bucket of cash, but you also have a tax liability attached to it. Third from the left or in the middle column, the domestic corporation files its U.S. income tax return and pays its corporate income tax. And now it's just a giant bucket of after-tax cash. It's inert. What do you do next? The next thing you do is you dissolve the domestic corporation. So what happens there? Well, what happens there is that's treated as functionally as if the foreign corporation sold its stock back to the domestic corporation in return for all of the assets of the domestic corporation, which is after-tax cash. That is going to be a tax-free event, and I'll leave it to the next slide to tell you the technical reasons why. But what's happened when you liquidate the domestic corporation is now all of a sudden your U.S. tax obligations on the sale of the U.S. real estate are fully paid up because the domestic corporation paid everything. And you managed to migrate the cash balance upstream into the bank account of the foreign parent corporation. And then final step is the foreign corporation has cash that is untethered by the U.S. tax system, and it can freely make a distribution of cash to its sole shareholder, the gray stick figure. And there you have the money in the pockets of the gray stick figure. Gray stick figure can go buy a hamburger and a beer without any fear of Internal Revenue Service. So that's the process. And we've done this many times for people. So why is it not a taxable dividend? Well, first things first. Section 897 says whenever there is a disposition of shares of a U.S. real property holding company, that's going to be deemed to be a taxable event. Well, a U.S. real property holding company is something that has U.S. real property in it, or it sold it, but it hasn't paid its tax yet. So once the C corporation has paid its tax on the sale of the U.S. real property, it's no longer a U.S. real property holding company. It's just a generic C corporation with money inside of it. Now you say, what happens when a foreigner sells shares of a C corporation? The answer is same as if the foreigner bought shares of Google or Apple. You sell it and the capital gain is tax-free. Why is that? It's because the proceeds from sale, or in this case, the liquidating distribution, are not considered to be fixed, determinable annual or periodic income, Section 871A, and it's not considered to be effectively connected income, which means the individual shareholder is not considered to be actively engaged in a U.S. trade or business, and therefore the income is not taxable at all to the foreign shareholder. And that's the underlying tax principles behind this whole process. So again, the how to be dumb and how not to be dumb. Again, it's somebody who's cheap and short-sighted, and they put all of their eggs in one basket. So now we have a domestic corporation that owns two pieces of U.S. real property, sells one. Can we liquidate the domestic corporation tax-free? Answer, no. Therefore, if the shareholder wants the cash, the shareholder is going to have to pay the 30% by withholding, or lower if treaty rate, tax on the dividend as is paid out of the domestic corporation. So again, how to be not dumb: use one corporation per piece of real estate. Cost of a corporation is cheap. The cost of a really simple 1120 every year is going to be cheap. Just do it. So the conclusion is, who knows? But my conclusion, my personal feeling is, I don't see a lot of difference between the corporate structures and the trust structures, at least on the capital gain side, unless the tax rates are changed dramatically, or the tax deduction rules for state tax paid are adjusted dramatically. You'll see I've sort of flagged around 60,000 of capital gain is where the California individual tax rate at 9.3 starts to exceed the corporate tax rate at 8.84 for what that's worth. But again, the numbers are so small that a client may not care that much. So anyway, final caveat is pre-solve for the branch profits tax problem. Know what you're going to do before you set up the structure so you know how you're going to exit. All right, let's move on. Income tax on rental income. The rental income is going to be much smaller, therefore the tax consequences are going to be much lower. Nevertheless, you want to take a look at it and be sure that you're doing it right. Okay, first things first. There are two ways that foreign taxpayers can be taxed on rental income. One is at 30% of gross, and the other is regular graduated tax rates that you and I love and enjoy on net income. And you always want the net income structure. And again, we're going to wave our hands at the branch profits tax as we go by, because if you're using a corporate structure and a foreign corporation, branch profits tax is a problem. And so you got to watch for it. So here are your citations for the two rules. So unless you do something affirmative, or you can make the Internal Revenue Service believe you later on an audit, the default tax rate on rental income from U.S. real property is going to be 30% of gross rent received. No deduction for interest, no deduction for property tax, no deduction for depreciation, no nothing. So that's bad. But if you are engaged in business in the United States, then you can be taxed on net income. So the same way that you and I would be taxed on net rental income. And so it's distinct advantage to be considered by the Internal Revenue Service to be engaged in business. Final bullet point, and this is one to tattoo on your brain. You can force the engaged in business treatment by making an election. And I give you the citation to the regs, section 1.871-10, that tells you how to do it. So do it. I mean, I cannot think of a reason you would not want to do it if you have the ability to do it. Now, back to branch profits tax. We talked about that. And again, just in the same way, we've got a problem with capital gain and branch profits tax. You pay your corporate income tax on gain, and then you pay 30% of the dividend equivalent amount on top of that. We've got some solutions to that, and use an irrevocable trust, use the parent subsidiary structure. So those are the first two bullet points. Do the reinvestment. Talked about that before. And the final one is never be profitable. So I'm just going to flag here on the Form 1120F the points of leverage that each of these use. So first one at the top, if you use a trust or you use a domestic corporation, by definition, you're not filing a Form 1120F. And the only place you're going to find the branch profits tax is on a Form 1120F. Therefore, you know that using one of these other entities will solve your branch profits tax problem definitively. The second one, line 1, zero out taxable income. In the early years of rental properties, it's usually going to be tax negative due to depreciation and deductions and whatnot. In later years, you might have taxable income out of the rental activities. The ways that you think about zeroing out taxable income are, number one, the owner makes a loan to the structure, becomes his own mortgage company, basically. And you make payments of interest from this structure that you're creating out to the owner as portfolio interest. So go look at section 871H for the rules on that. If you're going to use this, I think that mandates that you're going to have to use an irrevocable trust, because the portfolio interest rules say that if the lender and the borrower are related, and they define it as 10% shareholder or 10% partner, and then you can't use the portfolio interest exception and pipeline interest payments out to the foreign lender tax-free, which means that the borrower cannot be a partner and cannot be a corporation, which defaults to it must either be direct ownership, which you don't want because it has an estate tax risk attached to it, or it's a non-grantor trust, which is fine. So if you're going to use the portfolio interest structure, I think you're going to be using an irrevocable trust. And that way you're going to be able to do the portfolio interest lending that you want to. And then line 4C, that's the reinvest in earnings and profits. And frankly, this is probably the easiest way to go, because if you have rental income and it's not a large amount of money every year, you can pay out some of it as management fees. And that's, I guess, the other way that you can reduce taxable income to zero, by paying out net profit in management or consulting fees to the shareholder, who, if the person is doing the work from outside the United States, will not be taxable in the United States on the consulting fees received, which is good. So you get a deduction for the consulting fee paid in the United States, and the income is received tax-free, at least from the US perspective, by the person doing the work. So yay. But back to 4C. I mean, if you're taking your net rental income every year and you're just paying down the mortgage, what's easier? I mean, in the long run, you're going to be all fine, and you don't have any branch profits tax in the meantime. Domestic subsidiary, I want to flag, I'm not going to go into details, but you've got to watch out for this: personal holding company tax and the accumulated earnings tax. Both of these are going to happen and be risks. And in the early stages of life, when the amount of income is going through is not that much and the rental income is not too bad, you're going to skate, quite frankly. But later on, I had one where long held property, and at that point, we had a domestic C corporation pulling in maybe $2 million a year of net rental income. That creates a problem, doesn't it? And these things are designed to force you to pay a dividend out to the shareholder that's going to be taxed at 30%. So, moral of the story, I'm not going to get into the weeds about how to deal with it, but if you are using the foreign parent domestic subsidiary structure, pre-plan around the time when you care about the personal holding company tax and you care about the accumulated earnings tax on that domestic corporation. All right, domestic corporation handled. Let's talk on the other miscellaneous tax factors. First, the portfolio interest lending. I talked about that briefly a few slides ago. Section 871H is the way you do it. So if you have a foreign lender, let's say you have Mr. Big. Mr. Big is non-resident alien. Mr. Big creates, wants to buy US real estate for 10 million bucks. Mr. Big has 10 million bucks in his pocket, so he could do an all cash purchase if he chose to. But instead, what you're going to do is you're going to say, hey, Mr. Big, buy it 20% cash down and borrow 80% of the purchase price, because you can take an interest expense deduction for US income tax purposes. Mr. Big is going to look at you and say, who should I borrow from? And you're going to say, borrow from yourself. So you will set up Mr. Big BVI Limited, a little corporation that's a finance company, $8 million capital contribution to that BVI corporation. And then the BVI corporation is going to make a mortgage loan for the acquisition of this US real estate. The reason 80-20 is because if you have more leverage than that, you don't get to, that's the maximum you can take a deduction for interest expense. So short answer. So 80-20 or more conservative than that is what you're going to be doing. Now, the question is the equity piece. How is that going to be held? We've talked about corporations. We've talked about the irrevocable trusts. If Mr. Big has a foreign parent and a domestic subsidiary, and the property is bought by the domestic subsidiary, the borrower is the domestic subsidiary. And now you look at 871H, and it talks about this thing they define as a 10% shareholder. And you ask, is Mr. Big within the definition of 10% shareholder, a 10% shareholder of that domestic subsidiary? Answer using the attribution rules is, hell yes, he is. He's a 100% owner, and therefore the portfolio interest rule of Section 871H will not work. So that's why I'm saying default to using a irrevocable trust. It can be a foreign one or it can be a domestic one. So Mr. Big sets up a trust for the benefit of his family and capitalizes it with a $2 million gift. And then the trust buys the piece of property, $2 million cash down with its own cash, and it borrows $8 million from Mr. Big's BVI corporation. Now you're done. Now, Mr. Big, because he has no relationship to the trust, but more important, the borrower is not a corporation or a partnership, you can use the portfolio interest rule of 871H. What does that mean? It means the default rule that US source interest is taxable at 30% to a foreign lender no longer applies. Now the tax rate that applies is 0%. So all of the interest paid out to the BVI corporation is tax-free from a US point of view. That's the game that you're playing. Second thing, bullet point, personal residence. My preference is to use trusts because trusts are what God meant for this kind of thing. You have an asset for the personal use of a human. Corporations are designed for business activities. And for those of you who have been in practice for a while and you've had clients who are general contractors building buildings, and the sole shareholder happens to have a boat owned by the corporation and is trying to write off the expenses of the boat that he takes out on the weekend to go fishing. And you look at how the IRS looks askance at that kind of relationship, you know that there are too many possibilities for imputed income where you have a shareholder using a corporate asset. Now, I forget how long ago was it, maybe 15 years ago, maybe a little bit more. It used to be that you'd see Canadians come south to the desert out in Palm Springs, Palm Desert, and they'd buy a winter home there and they'd hold it in a Canadian corporation. Well, the Canadian tax authorities said, hey, look at this. And they changed the laws in Canada to say that if you do this and you have a personal use asset in a corporation, we're going to treat you as if you had deemed dividend equal to the fair market rental value of that house inside there. And hey, presto, these structures were no longer very attractive for Canadians. I personally think sooner or later the government's going to get around to stuff like that. Anyway, long-term, use a trust. Finally, future gifts. People may want to move assets around It's really easy and tax-free to make a gift of foreign corporation stock, even if the foreign corporation has US real estate directly or indirectly owned underneath it, and it's a tax-free event from the US gift tax point of view. But my experience is there's a lot more nuance and possibility if you have a trust and you can change the beneficiaries, or you can change the beneficiaries' percentages, or you can do stuff like that. And so long term, I prefer trust just because it gives you more flexibility. Finally, not on this bullet point, but FERPTA withholding. Everybody gets all wrapped up about FERPTA withholding, the 15% on sale. The big problem comes up with this if the property's underwater. There's just simply not enough cash after you pay off the costs of sale and maybe an existing mortgage. There's not enough cash left over to pay the 15% to the IRS. So you've got a problem with the FERPTA withholding in a scenario like that. There is a way in which you can deal with FERPTA withholding by asking for a withholding certificate, Form 8288B. That takes a long time. But you got a problem. But basically, people misunderstand the 15% and they think it's a tax when it's just really a prepayment against the actual tax liability. And frankly, the real problem is what happens if you have a non-resident alien or a foreign corporation that's entitled to a tax refund, and the Internal Revenue Service mails out one of those 1960s vintage, paper checks to these people somewhere in Italy or Burkina Faso or somewhere like that. And how the hell are they going to cash that check and get their money, especially if you've already dissolved the foreign corporation, so it's impossible to have a bank account? That's a much bigger problem. So the problem exists for the FERPTA withholding. Frankly, if you can interpose a domestic entity between as the actual seller, then you've eliminated the problem. And one way to do that is to have an LLC, and right before the sale happens, you make a C Corp election. Now you've got a domestic C corporation that sold the property, no withholding. The tax rate is 21%, so it's fairly benign, and on you go. Conclusion. Right, step one, look at the estate tax. Step two, personally, my opinion is that income tax on capital gain and rental income, not so worried about it. Point three, my personal bias, which you've heard a few times, is I like trusts. They're good, they're flexible, they're long-term, and they're designed to hold passive assets for the benefit of humans. Think of them and use them if you can. There's my disclaimer and warning and all of that. Ping me an email if you have a question. If you want a copy of these as PDFs, if you didn't get one before, if you want a copy of those tax returns I told you about that showed the calculations side by side of foreign corporation seller versus human seller. And off we go. We'll see you next month. It's going to be a compare holding structures for foreign businesses owned by US persons. So looking the other way, outbound US citizen operating real businesses outside the United States, how should you think about that question? Until then, see you next month. That'll be November 19, so we can avoid the Thanksgiving weekend. Bye.